Good afternoon, and welcome to AIADA's AutoTalk. I'm your host, Rachel Soleimani. Before we get started, a few quick reminders as always. Anyone who is registered for today's program will be receiving a copy by early next week. And if you have any questions, be sure to enter them into the Q&A bar at the lower right-hand side of your interface. Today, we welcome back our dear friend, Erin Kerrigan, founder and managing director at Kerrigan Advisors. Erin, I know you have all of 2022 to report on and what we're seeing already in 2023. So I'm going to let you take it away.
Okay, thank you, Rachel and AIADA, for the opportunity to present Kerrigan Advisors' 2023 buy-sell market outlook on the heels of the publication of our annual report last week. As with everything since the pandemic, the buy-sell market and blue sky values are certainly challenging to forecast and seemingly changing all the time. During our time together today, I'll review our firm's analysis of both 22's buy-sell market and first quarter trends we are seeing for this year. However, in terms of a full outlook for 2023, there is no question it is very difficult to predict. To that point, you'll see I'm employing a ski theme to today's webinar. As some of you are aware, when I am not on an airplane, I reside in Lake Tahoe, Nevada, where we still have several feet of snow after record snowfall. The unexpected weather patterns that we have experienced this ski season have certainly reminded me of our recent buy-sell market, which saw its own unpredictable shift last year. Now, through the third quarter of 22, we continue to hit all-time records in transaction activity with 845 franchises sold through the trailing 12 months ending in September. Of course, this tremendous activity was driven by dealers' burgeoning cash accounts. Auto retail achieved its third consecutive year of record earnings last year, increasing over 200% from the pre-pandemic average. Now, collectively, over the last 3 years, the average single dealership has amassed over $10 million in profits. And given that most dealers own around 3 dealerships, that amounts to over $30 million in capital looking for a home to invest. However, as good as all that sounds, and as strong as the buy-sell market was through the third quarter, industry headlines turned noticeably pessimistic as the year progressed, particularly as interest rates rose at a pace unseen since the 1980s. Average negative equity on trade-in vehicles increased by over $1,500 by the end of the year, and the number of weeks of income consumers needed to purchase a new vehicle shot up to over 44. This also led to a rise in auto loan delinquencies, which increased to levels unseen since the Great Recession. Wall Street certainly took note of these rising economic risk factors. Investors became more and more concerned that auto retailers were in for challenging economic times, resulting in their stock values declining to the lowest levels seen since the pandemic. The Kerrigan index of the 7 publicly traded auto retailers declined by 26% in just the second half of the year, leading to the public's trading at the lowest blue sky multiples on current earnings in recent history, from a high of 8.1 times in the first quarter of 21 to a low of 2.9 times in the third quarter of 22, a 64% decline in multiple. Now, knowing that most transactions take at least 3 months to close, it is not surprising that the public's trough multiple in the third quarter of last year led to a dramatic reduction in transaction spending the next quarter. Specifically, a $5.9 billion decline, as you can see here. Whereas in the fourth quarter of 21, the public spent a record $6.2 billion. By the fourth quarter of 22, they spent just shy of $400 million that quarter. Ultimately, this lack of spending resulted in a 50% plus decline in franchises sold during the quarter. The fourth quarter's lack of spending by the publics led to an unprecedented $7 billion decline in spending for the year. Now, one would think that with the publics exiting in such a major way, that we would see a significant decline in industry transaction activity for the entire year. But instead, we experienced just a measly 2% decline. Now, of course, we saw fewer mega deals that included a lot of franchises. But all in all, what we really observed was that private dealers with all of their capital doubled down on growth and took advantage of the public's exit from the market, resulting in a seesaw effect in terms of buy-sell market share, with the largest privates increasing their share to 18%, notably 3 times the public's in 22, and smaller private dealers seeing their share increase to the highest level since 19. 76% of the buy-sell market was driven by smaller private dealers. In fact, private dealers acquired a record number of franchises from the publics. The public sold as many stores as they purchased last year, selling 66 and buying 66. An about face from 21 when they added a net 246 franchises to their portfolio. Now, to some degree, the public's divestitures were not surprising when considering their low blue sky multiple, especially when compared to the average private franchise multiple, which has remained relatively consistent at around 4.5 times. It's important to note that the oddity of this situation in our industry. Typically, public companies have a dominant industry position and always trade at a premium to private companies in the same sector. However, because auto retail remains private, 94% of dealerships are owned by private companies, fluctuations in the public markets typically have minimal immediate impact on industry valuations or buy-sell activity. Now, the disproportionate growth of the largest private groups in 2022 reflects one of the key drivers of industry consolidation today, and that is the need for scale, particularly as industry changes related to investment in technology become a distinguishing characteristic of future success. As you can see here, dealership groups with fewer than 5 dealerships continue to shrink in number, while those with greater than 11 rise at the highest rate. Consistent with that data, according to the 2022 Kerrigan dealer survey, most private dealers continue to seek growth, with 48% looking for acquisitions, and very, very few are planning an exit, just 2%, even as economic headlines become more negative. This, of course, is largely due to the attractive returns available in auto retail, particularly the consistently high return on equity. This slide here shows average dealership return on equity down slightly in 22 from 21's incredible level. And these returns are certainly difficult, if not impossible, to replicate on a risk-adjusted basis in other investments. Dealers know this. Even in the depths of the Great Recession, the average dealership earned a remarkable 24% return on equity in 2009. Largely because of the resilience of the business model in both good times and bad. In fact, many consider an investment in auto retail a relatively counter-cyclical one. As you can see here, even when interest rates rise and fall, auto retailers' profit margins are dependably consistent. Of course, with the exception of the recent hockey stick, which is an even bigger improvement of prior years. In fact, sometimes we even see profit margins increase in rising interest rate environments, as we saw in 2015, and we also saw last year, when profits rose despite interest rates increasing 425 basis points. Now, this historic phenomena is largely due to the industry's pricing power, as well as the 4 business lines of new, used, F&I, and service, which often counterbalance one another to ensure a more consistent profit profile. We are also blessed with a very high variable cost structure, which enables quick expense reduction when revenues decline, making for an attractive business model. As we look to 2023, there are many reasons to be optimistic about auto retail's profit potential, starting with the used car business. Now, while used cars did experience a price correction in 22, that trend is reversing in 23. Through the first quarter, Manheim's index has increased nearly 10% from 22's lows, and many dealers expect used car prices will settle at higher average price points going forward. In particular, late model used cars will be difficult to stock as a result of depressed new vehicle sales since the pandemic and fewer lease returns. Limited supply, coupled with rising demand for affordable transportation, likely bodes well for the used car business this year. Also, fixed operations, the highest margin business segment for dealerships, is expected to continue its double-digit growth rate in 23, supported by an increase in vehicles in operation coming off warranty, pent-up service demand due to improved parts availability, a continued increase in miles driven, and the counter-cyclical impact of higher vehicle retention in the event of an economic recession. All of these factors will likely buoy dealership earnings in 23 and help to counterbalance the decline in new car margins, which are starting to decline for sure, as vehicles are now priced below MSRP. And we heard about it on the recent earnings calls from the publics for the first quarter. This being said, I do think the market is increasingly recognizing the mitigating factors of higher future sales volumes, which will likely offset some of the decline in total new vehicle gross profit. There is an estimated 6.2 million in pent-up retail, not including fleet, retail new car demand as a result of the lack of supply over the last 3 years. Many dealers are looking forward to a rebound in new vehicle sales as inventory availability improves throughout 23, and they anticipate OEM incentives return, supporting higher inventory turn rates and lower days supply. Now, taking all this into account, the publics, which are currently sitting on a record $7.6 billion of liquidity, have seen their valuations rebound considerably in 23. 5 of the 6 have hit all-time record market caps in February, and the Kerrigan index remains up nearly 14% through March, despite market gyrations due to the banking sector's turmoil. Increasingly, we see investors recognizing the strength of the diversified auto retail business model and the numerous positive financial factors that are likely to support dealership earnings going forward, even in the event of a recession. With that overview of the buy-sell market, I'd like to now highlight some of the trends we discussed in our annual report. And the first one being the fact that we are seeing buyers becoming much more selective with their acquisition criteria. Whereas in 21 and 22, buyers seemingly were willing to acquire any franchise in most locations, regardless of volume, queuing up just to get a chance to expand their business and put their tremendous capital to work. By the end of last year, growing dealer groups were becoming much choosier and unwilling to wait in line. This year, the cream is starting to rise to the top, with buyers only seeking the best franchises and being more judicious with their capital, still willing to pay a premium for top franchises in high-growth, business-friendly markets, such as Florida and Texas, but increasingly discounting or completely avoiding riskier franchises in lower-growth markets. In this regard, the buy-sell market of 23 is beginning to diverge into a have and have-not marketplace, where certain dealerships remain in high demand, commanding price premiums, while others struggle to identify a buyer. In particular, beginning in the fourth quarter of 22, Kerrigan advisors noticed buyers shifting noticeably toward import franchises over domestics. In fact, in the fourth quarter, import franchises increased their share of the buy-sell market to 61%, 43% for non-luxury and 18% for luxury, while domestic franchises saw their buy-sell market share decline to just 39%, a market change from the 57% they represented in the first quarter. As domestic inventories begin to rise without a commensurate increase in sales, as you can see on the bar chart on the right, Kerrigan Advisors finds buyers migrating away from domestic franchises, particularly low-volume ones and those in low-growth markets. Instead, they are focusing on less risky imports, particularly luxury. Luxury outperformed non-luxury sales in 22 by 670%, and this trend continues in 23, driving increased buyer demand for top luxury import franchises such as Mercedes, Lexus, BMW, Porsche, JLR, and Audi. In addition to more selective franchise acquisition criteria, Kerrigan Advisors sees buyers increasingly migrating to high-growth population markets. Now, not surprisingly, the top 10 most requested states within Kerrigan Advisors' proprietary buyer database are also some of the highest growth states by population in the U.S. The demand for smile states clearly continues. Note that 34% of buyers in our database want to buy a dealership in Florida, the highest population growth market in the U.S. and the most requested state in our buyer database, followed by Texas, with 28% of buyers requesting that state. Now, the next important trend that we highlighted in our annual report is how blue sky is being valued today. Much like the remarkable about face in our Sierra snowpack this season, as compared to the drought we experienced last year, the way in which blue sky is being valued has also changed quite dramatically. It is important to remember that a business's value is usually based on a buyer's expectation of future profits. Now, previously, buyers often averaged the last 3 years of earnings to estimate expected future profitability when they were determining what they were willing to pay for blue sky. This methodology proved extremely effective. As you can see here on this chart, from 2016 to 2019, average dealership earnings almost perfectly reflected the prior 3 years' average earnings, the white line on this graph. However, beginning in 2020, when we saw earnings really start to soar, the calculus for projecting future earnings based on the last 3 years of profits started to really miss the mark, leading to a $1.9 million gap in 22 between the actual earnings and the average of the last 3 years. Buyers and sellers have since struggled to assess future profitability given the seemingly unpredictable nature of the industry post-pandemic. The past is no longer a prologue, and a new methodology for earnings projections is clearly required. With this in mind, Kerrigan Advisors finds most buyers are ignoring the last 3 years of earnings in determining blue sky value. As an alternative, many are beginning to project future profit margins rather than profits, often averaging historical net to sales margins and then applying that average to current revenue in order to project normalized profits for valuation purposes. Now, employing this methodology to the average dealership results in a normalized net to sales expectation comes to a 4 to 5% level. Potentially the new normal if the industry successfully retains some of the operational efficiencies gained during the pandemic, as well as higher new vehicle margins relative to the pre-pandemic industry lows. Now, keep in mind that at 5%, that is more than double the historic average and reflects the expectation of a new and improved industry going forward. Now, when applying these projected margins to current sales, blue sky values range between 3 and 8.75 times of normalized profits. These valuation metrics are consistent with the current transaction pricing Kerrigan Advisors has observed in the marketplace. As you can see on this sensitivity table, if you, for instance, are currently earning 8% net to sales on your business, but expect to normalize around 5%, and let's say if you're a top franchise and valued around 35% of revenue, that range, you can expect a blue sky multiple on current earnings of 4.38 times and a blue sky multiple on normalized earnings of 7 times. This table helps to assess blue sky multiples based on both current and normalized profit margins, as well as a percentage of revenue. The last trend I'd like to discuss before we talk about Kerrigan Advisors blue sky multiples is dealership real estate. Rising rates, like rising temperatures, typically have a significant impact on the financial markets as well as real estate values. As interest rates rise, the cost of capital increases, reducing investors' return on investment. This leads investors to demand higher returns in order to compensate for their increased cost. The demand for higher returns usually leads to lower real estate values. Since last year, commercial real estate values have declined an average of 15% in the US. With inflation still elevated and unemployment low, many investors expect the Federal Reserve will increase rates to 5%, to the highest level since 2006, likely leading to more downward pressure on commercial real estate prices. Now, while the current banking turmoil may be mitigated and may mitigate future rate increases, disruption in the financial sector likely will lead to an increase in borrowing costs, resulting in higher costs of capital for investors, even if interest rates decline. Dealership capitalization rates on real estate typically rise and fall with interest rates. There is a clear inverse relationship between capitalization rates and real estate values. At 22's dealership rent rate, the average rent rate, the average dealership real estate value ranges from a high of $16.5 million based on a 5.5 cap rate, which is probably hard to achieve today, to a low of $11.3 million based on an 8% cap rate. Now, if interest rates continue to rise and recession risk becomes a reality, the industry could see cap rates rise, resulting in a correlated decline in dealership real estate values. To this point, for the first time since the pandemic, we are finding that real estate appraisals are coming in below our clients' expectations, and buyers are starting to hyperanalyze appraisals to ensure the valuations accurately reflect a shifting commercial real estate market. Okay, now that we've discussed these trends, let's turn to the specific franchises and wrap this workshop up with dealers' perspectives regarding the OEMs. Kerrigan Advisors finds that while dealers are actively preparing for changes to the retail business model and EVs, OEMs are becoming increasingly aggressive in their attempts to manage their networks, forcibly pulling along their dealers towards investments that are often contrary to franchise law or intervening during buy sells in a manner that is manipulative potentially. We see these maneuvers undermining the franchise system and the value of the franchises these OEMs represent. This is most notable in the case of Ford, the OEM most aggressive with their proposed new EV retailing model. You can see that 59% of dealers now believe Ford's proposed changes will have a negative impact on future dealer profits, followed by Chevrolet and Volvo. Now, by contrast, Toyota and Lexus dealers have the most positive outlook regarding OEM changes, with 22% of Toyota dealers actually expecting their adjustments or changes in the future to increase the franchise's profitability. As an industry, we believe we are in a very precarious point where OEMs are deciding whether they will work with their dealers to manage through industry changes in a win-win manner or against them with a zero-sum game mentality. How OEMs approach the coming changes will have a meaningful impact on blue sky values and multiples over the next decade, and we expect to see some significant changes as a result. With that in mind, in our report published last week, we maintain a negative multiple outlook on both Ford and Chevrolet, as dealers are increasingly skeptical about future profitability of these franchises given expected changes to the retailing model and are quite distrustful of the OEM. We could see both of these franchises decline in multiple in 23. We also downgraded Honda's franchise outlook to negative and reduced its high-end multiple by a quarter point. We expect there could be additional reductions in 23. As most of you on the line are familiar, Honda not only lost the most market share of any franchise in 22, it also riled up its dealer body with its Sony partnership, which will produce EVs sold direct to consumer. Honda's franchise workaround is highly alarming and has degraded trust in the OEM. By contrast, our multiple outlook for both Kia and Hyundai remain very positive. These franchises now outsell Honda on a sales per dealership basis and continue to take market share. We expect both will see their multiples increase this year. One additional change that we made to the non-luxury franchises this quarter was a reduction in Stellantis's multiple, both on the high and low end. The franchise is sitting on over 100 days supply of vehicles, and yet sales continue to decline. The OEM's lack of discipline with regard to inventories, coupled with weak demand for its products, particularly without OEM incentives, is concerning to many of its dealers and has resulted in a significant reduction in profitability and buyer demand. Another trend occurring in recent months is OEMs seeking to reduce their franchise network count with cash buyouts and incentive packages. In the case of Buick, General Motors is paying certain dealers to relinquish their franchises. These buyouts appear to be for a fair price. Kerrigan Advisors believes Buick could ultimately improve the value of their remaining franchises by increasing new vehicle throughput per franchise, a key metric that drives valuation, particularly if Buick GMC franchises can continue to take market share as they did in 22. Now, like Buick GMC, Cadillac on the luxury side has also quietly reduced its franchise count from 875 franchises in 20 to just 564 in 22, removing 300 franchises from the network. Kerrigan Advisors observes an increase in buyer demand for Cadillac franchises, especially towards the end of last year, and expects Cadillac could see its multiple rise in 23, resulting in a positive multiple outlook in our report. Cadillac had the largest sales per franchise increase of any franchise in 22, up 45%, resulting in increased dealer profitability, particularly in major metros where franchise consolidation is meaningful. On the whole, with regard to luxury, we believe the top import luxury franchises, those 6 on the upper left-hand side of this graph, will continue to outperform the market. This is given their limited supply and the fact that these franchises, particularly those in high population growth states, continue to command multiple premiums. We don't see that changing unless, of course, these OEMs change their retailing model dramatically. We have certainly seen some aggressive moves by some of these folks beyond our borders, with some of them actually changing the model quite dramatically and coming under legal scrutiny. So we're keeping an eye on what these top luxury franchises are doing outside the US. In closing, and in keeping with my ski theme, Lindsey Vonn, the first American woman to win gold at the Olympics for downhill, reflected after Olympic gold and said, "If you work hard, it will always pay off in the end." While the future of the auto retail industry is certainly an unknown, given the multitude of changes on the horizon, the one thing I am extremely confident of is the strength of the dealer work ethic. Like Lindsey, you are champions of this industry, and I know you will adjust to the times and the circumstances to ensure you achieve lasting success. Thank you very much for your time, and I think we're going to open it up, if we have time, to a few questions.
Yes, Erin, we had a couple questions come in, so I will read them off for you. The first one was, you've mentioned that Cadillac and Buick buying out franchises. Jaguar has also been doing this. What are your thoughts?
Yeah, so Jaguar is actually not buying. They're putting JLR is looking to take Jaguar to more of an exotic level in terms of brand. And so rather than buy out the franchise, they are offering higher levels of allocation in Range Rover in order to incentivize dealers to give up the Jaguar franchise. That has not proven, I don't think, as effective as a pure buyout. And so I think the jury is still out on that method. It is somewhat ironic they're doing this after having pushed dealers for at least 5 years, maybe more, to merge Jaguar and Land Rover and build one of the most expensive facilities in the industry. And now they're saying, hey, we want you to give up your Jaguar franchise. So that's a pretty difficult one, I would say. And I think a lot of dealers are just keeping the franchise because they're not getting enough compensation effectively for relinquishing it.
Thank you for that. Then the next question is, how do you think the banking turmoil is affecting the buy-sell market in 2023?
Well, obviously, the crisis continues to evolve, and it seems that we may be avoiding a major crisis, but we are starting to hear of acquisition financing terms becoming more onerous and expensive. And we certainly have already seen 2 banks exit the floor plan market. So it's something we're keeping a very close eye on. We have talked to buyers who said, look, I have a line with my bank and now they're asking me to do X, Y, and Z, and they've increased the fees on my line for acquisitions. That typically will play out somewhere in the buy-sell market in terms of valuation. So it is something that I expect we'll talk about in our first quarter Blue Sky report.
We look forward to seeing that report. And I think we have time for one more question. And that is, have you seen an increase in OEMs using a right of first refusal during deals to control who buys their franchises?
We have definitely seen an increase, and that's why I was hinting at in sort of the maneuvers we're seeing as it relates to buy sells by the OEMs. There seems to be, with some OEMs in particular, a desire to truly control where their whole network and minimize the number of dealers, so that they, I suppose, feel that they can work more closely with fewer dealers. It is a challenge, and I do always advocate for dealers to advocate within their states to disallow ROFRs, because they ultimately do have a negative effect on valuation in my experience. When a buyer knows there's a high chance of ROFR, they just are less likely to do the deal. And if anything, they're more inclined to say, look, I need to talk to the OEM and make sure they're going to approve me before I make you an offer on your deal. And that that manipulates the buy-sell market and doesn't create a full free market as it relates to who's the ultimate buyer at the highest price. So I do think this is a critical issue for the industry, and I hope that dealers continue to lobby for the elimination of ROFRs as we have in certain states, and because I do think it will have negative impact on franchise value.
Well, Erin, thanks so much for joining us today. We love having you on throughout the year. The buy sell report and the Blue Sky report are such valuable assets to have, so thank you for always sharing them with us. Again, you will all be receiving a copy of this webinar by early next week. To those on the line, join us back here on Thursday, yes, 2 days from now, April 27th at 2 p.m. Eastern, as AutoTalk presents its famous used car super session with help from Carfax and ACV. So be on the lookout for promotions on how to register. For more information about AIADA, visit aiada.org. Thanks for tuning in and have a great day, everyone.